All right, guys, welcome back. It's been a while here. So today I'm going to be breaking down one of my what I call my highlight for the week. One of the my biggest highlights or my biggest trade for the previous week. And there are two trades outlined here, or there are two trades in this particular chart that I took, and I'm going to be breaking that down. And I'm going to show you a little bit of how to look for or how to validate your reference points, be them demand zones or order blocks or whatever you call them, the SE candles, or your area, your point of interest. I'll be showing you some way, but I have an ultimate way to do that. But let's just look at this trade and the reason why I took this trade. Now I'm going to go to the 15-minute time frame where all the details are. Now, if you look very well, you're going to see. First of all, you know what this is. This is a demand zone, if you want to call it that, or an area of demand, or a point of interest, or your order block. And that's just basic. We all know that there's a reaction here and price traded higher, but this happened in a bearish marketplace. We're going to go to the daily time frame, and you will see that this marketplace had already been bearish for such a very long period of time. As you can see right here, that was the zone or the area where that trade was taken from. So what would prompt me, or what would be the reason why I take a trade against the trend? And it goes back to some of the things that I'm going to talk about later on in this particular video. And one of them is what I call one superior thing that stands out for me in order before I pick reference points or before I pick demand zones, SE candles, order blocks to work with. It's the ultimate for me. But let's just go into the 15-minute time frame where this trade was taking, and everybody would be able to tell, or you would be able to see why I took that trade, but you won't see the what I call the most supreme context for me. Now, here we had an order block or a demand zone, and we had price running back into that area at a particular time of the day. That was during New York, that time of the day. So we were expecting, and it was a news event or a macroeconomic event that took that gave us that juice that was required to give us that rally. Now that right here was the entry, and the stop. I'm gonna put it now. So we had an entry right here, and the stop was just below that particular order block right there. So just about that, and that was for a total of 11 risk to reward, or 1 to 11 risk to reward. And I'm going to show you that was the very first trade. But if you look in, what I always tell some of the traders that I work with is the very first order block or the very first demand zone. If you're not so sure, there's something that you can do. You can always reduce the risk on the very first entry. And when that entry has been validated, you can actually go to the 15 or you can refine further into the lower time frame. And what I mean is you can refine into the 5-minute, and you're going to see a fractal movement or a fractal behavior in price, or the same behavior that you find on the 15-minute time frame or whatever higher time frame chart you use. So if you go to the 5-minute, one way to validate that particular order block would be to go to the 5-minute. Now, when you go to the 5-minute, I want you to look at this behavior right here. Now, do you see that behavior? Now, this is a copy of the 15-minute time frame behavior. That's a copy, okay? Now, this would give you a certain level of validation to this particularly original level. So if you were going to use 100, you were going to use one standard lot for this particular trade or this particular entry, and you used 0.2, and that was 20% of the original, and you see the same copy printed out on the lower time frame. You go to the lower time frame and you find the same copy of what you found on the 15-minute time frame. That is one way to validate your entry or your original entry. You can come back here, or you can come back, you can actually go further down or refine further into the 3-minute or the 1 minute. But the moment you see the same copy, or you see the market printing the same copy of what you saw on the 15-minute time frame, that validates your entry. But I'm not going to say it is 100%, because there's a superior context, what I call the superior context, that once I see that, I don't need to see order blocks, I don't need to see demand zones or SC candles. What I need to see is a particular event in price. And once that event in price is formed, what we see next on lower time frame will be a trail of demand zones to work with, SC candles to work with, or order blocks to work with. Now, in this case, this would have been your second entry. That would have been your second entry right there. Low risk, very low risk, just right there. And that was the reason I took this trade. If you go up to the channel, the link is going to be in the description. You will find these two entries. You see me taking these two entries. That same trade. And both trades cumulative gave a total of 1-11 risk to reward. That was the very first trade. This is very simple. I'm not going to keep it, I'm not going to make it complex. That was the reason to take this trade. But here, how do you do that on a marketplace whose order flow has been bearish for a long period of time? Why do you do that or trade against the current of the market? Why do you do that? I'm going to break this down. I'm going to go back to the 15-minute where we took the original entry. And before doing that, if you had taken this, that would have been less than 5 pip, a risk of less than 5 pip. So you'd have been, your stop would have been just below here. Okay, that would have been a 3 pip stop. Okay, a 3 pip stop, and you would be on your way. And that would have been the area where you take the higher portion or the complete portion of your 100%. So if you took 20% at the first entry right here, you would be coming back here to take the remaining 80% and taking that because your reference point has been validated. I want you to go back. If you don't get this, go back. You can take back the video and listen to what I said. You want the same type of price action printed on the lower time frame. When that happens, it validates your reference point to a certain degree. It's not 100%. Like I said, there's one thing that trumps everything. Once you know that, you do not need order blocks. You do not need, you understand that these order blocks are going to form as a result of that particular event, or these demand zones or these SC candles are going to form as a result of that particular event. That is the reason. And so because when this particular event happens, it creates very, very strong, high probability reference points to work with. Okay, so it's one event that we want to see that forms all of these things. Okay, and so I'm going to go back to the 15-minute time frame now, and now on the 15-minute time frame, if you reduce this and go, let's go to the 1 hour, and we're going to break this down to, the daily time frame. If you look clear enough, you're going to find something. You're going to find price moving violently down. Of course, order flow is bearish, and you see price moving violently down. We found a form of distribution, redistribution or distribution, and then followed by a move down. Now, the move down happened. Price goes back violently to clear what we call interests above these high. Okay, we have interests above this high, or liquidity above that high, and so it clears that very violently and repeats the same behavior here. Now, this time it is not an accumulation, a typical distribution that you find here, but instead you find that slow movement to the downside, and you see what you want to call more like a stop hunt. Okay, a lot of folks are going to be thinking, well, that event, is it the stop hunt? Are you referring to the stop hunt? Well, basically no, but we find a stop hunt, and we saw that violent move in price. Now, remember what I told you in some of the previous videos where I talked about the time it takes to cover a particular move, and that would determine where price is headed next. And here we have a very slow movement to the downside, a really slow move. It took a whole lot of time, and we find very fast, followed by a very fast move to the upside. And look at what happened. We cleared liquidity to the downside, or we took out the interest here in form of a stop hunt, and price traded higher and formed that particular entry that we were looking for. And when that happened, that was the reason why we took the trade, because the essence of this happening would be going back to take out interests above here. If it did so above here, it would do so above these levels. Okay, it would do so, and that it failed to complete this area, but what happened, it took out this high. We saw that high, we saw the interests above that high, taking out. And what happened? It went back into a reaccumulation following or going into the second day. And this brings me to the second trade, and that is Friday's trade to close that. I think that was Thursday's trade rather, that closed the week for me. So this takes me back to the second trade, which took out interests above this area. Okay, and let's go into that now and determine, because here in this particular area we have a problem. I'm going to increase this because I want to use the 1 hour time frame because it has less noise. And yeah, now this particular area, as you can find, we saw a whole lot of wick movement here, and this was an accumulation. Okay, and what would be a very, very reasonable area for us to see price begin to trade higher? Well, you would say we have a gap right here between this area and this area. It's a gap, right? And what would be the most reasonable or the best part of that gap or that void to be a buyer, to expect that move to take out these interests? What would be the best place? Well, some folks are going to say here, but there's a way you can actually break this down to, leave this area out of your entry. Okay, if you look at this particular move all the way from here to this point, this is the gap. From here, I'm going to mark that now. I'm going to change that. So how do we identify, or how do we pick the best area? Because we have a really huge gap right here. And that means if we're going to use this, we're going to have a really long stop loss. So we're going to be risking a lot, and it's not a good trade. So there's a way you can actually do this. There's a way you can actually reduce and refine further and get to understand the best place to be a buyer. So I'm going to change the color. And I'm going to use the red. One second. Okay, so if we expect that we have, or that we have what we call a gap within this zone or within this area, and some folks are going to give are going to put their entries here. But if you use that as your entry, you're going to suffer. You would suffer a really huge drawdown while you wait for price to really be done with its move. So you would have suffered a drawdown of 11 pips. 11 pips. My stops are max 11 to 15 or even 20 pips, but I do not like to hold a stop for 20 pips on a 1 hour time frame. Okay, you could do that for maybe a 4 hour time frame, 20 pips, but for the 1 hour time frame, I try and I like to refine, and I try to refine further on the lower time frame in order to get a better entry and a better and lower risk. So if you look within this area, you're going to find that this is at the top half of the move to the upside. We have two halves. Okay, so if we had two halves here and we have a really huge gap, then I would expect price to trade way into. So the best idea would be, okay, we're going to use 50%, but there's an extra layer of refining that can be put into this. I'm not going to go into it because it's going to be too cumbersome. It's going to be too long. But the best way would be to, okay, if you have a large gap, you want to use 50%, but there's a better way to refine further and to get a lower drawdown and a good entry with low drawdown. And your stop could be just below or on the body of this candle or below that candle. And it would be anywhere from 7 to 11 pips. So let's check it out now. I'm going to use this, and this would be 50%. That would be your entry. That would be 15 pips, but the entry isn't quite. Okay. 50%, your stop would rest just here, 10 pips, and you would have suffered just about a 7 pip drawdown before price traded back to take out your interest levels. And that would have been a 50 pip move, and that gave about a 1 to 5 risk to reward at the end of the day. So that's one way. But before I end this, I like to point to the fact that the ultimate way for me to identify some of the best reference points to work with, it would be best to study price and look for an event. The thing is, you've probably seen this a couple of times. You've probably seen it, but you paid very little attention to it. It's always there. It always happens. You need to take the time to look for it. And I'm going to be showing you more of these and as time goes on, and the power of this particular method of this particular event. I call it an event because these events would lead to a formation of reference points. And these reference points formed by that particular event are high probability. And basically, you could use these events or these levels to, you know, do a whole lot in the market in terms of what you could do every single week. So these were some of my best trades for the week, mostly basically the best 2 trades that I took these past week. And that's why I'm going to draw the recording, and I'm going to talk to you later on, guys. So I hope you've learned something from this, and I'll see you next time.